Welcome to an investment deep dive into persistent systems. We're looking at the Q3 FY26 performance review to see if this company truly is an unstoppable growth machine. Consistency is king here. While the market is volatile, Persistent has delivered sequential revenue growth for 23 consecutive quarters. This quarter, revenue hit 3,778 crore, marking a 23.4% increase year over year. You might see a headline about a profit dip, with reported profit falling 6.8% quarter over quarter. However, this was due to a one-time statutory cost of 89 crore related to new Indian labor codes. Excluding this one-off, underlying margins remain robust. The order book is bulging, providing strong revenue visibility for the rest of FY26 and into FY27. Total contract value stands at $674.5 million, with demand remaining particularly high in cloud and digital engineering. The star performer this quarter is the BFSI segment, banking, financial services, and insurance. It grew a massive 33.6% year over year as banking clients spend heavily on digital engineering despite global macro fears. Persistent is evolving beyond standard IT services. Microsoft recently recognized them as a frontier firm for agentic AI. This validates their technical capability in the hottest sector of the decade, building autonomous agents. They maintain a fortress balance sheet that is cash-rich and virtually debt-free. Total assets have expanded 25% in 9 months to nearly 11,000 crore, and cash and investments have jumped 49% since March 2025. Management is confident enough in their liquidity to increase payouts. They've announced an interim dividend of 22 rupees per share, up from 20 rupees last year, so you get yield while the growth story plays out. Are the earnings real? The data says yes. Cash conversion is excellent at 91%, and their collection cycle is a healthy 57 days. There are no accounting gimmicks. Profits are turning into actual cash. The people engine is also revving up, with a headcount of over 26,000 after adding 1,400 people this quarter. Utilization is high at 88.4%, and attrition is down to 13.5%, signaling a healthy culture. What could go wrong? First, the 89 crore labor hit shows that regulatory costs can hurt margins unpredictably. Second, they have a heavy 81.5% dependency on North America. And third, their top 10 clients contribute nearly 44% of total revenue. Persistent commands a premium price for its premium performance. With an $11 billion market cap, the stock trades at a higher valuation than peers because the market pays extra for its 4% plus organic quarterly growth and predictability. A final safety check shows no aggressive capex, manageable receivables, and no one-off boost to earnings. In fact, earnings were actually suppressed by one-offs this time. The gap between profit and cash flow remains solid. The final verdict is constructive. Despite the statutory margin hit, Persistent Systems remains a top-tier compounder with 23 quarters of sequential growth and clear AI leadership. If you found this visual deep dive helpful, make sure to like and share. Follow ZinvestZ for more smart investing insights. Thank you.